Well, welcome. And if you do have questions that are pertinent to where we're at in this presentation, feel free to type those into the chat box, and we'll try to address those right away if it's something that we don't think you can wait until we get to the end of the seminar. So the topic that I'm going to address here today is marketing wheat in the current volatile environment. I think you can all appreciate that. We're going to spend a little bit of time reviewing some price history and some price relationships. We're going to explore some pricing strategies for old crop wheat. We'll spend a little bit of time talking about developing plans for new crop wheat pricing. And if we have time towards the end, we'll have a discussion on some corn and soybean marketing opportunities that may be available soon, and maybe some defensive strategies that we want to take a look at. So with that, let's get started. Here is the September 2022 spring wheat chart. And I think you can all appreciate that we had a considerable rally in wheat. Spring wheat especially got all the way up to $14 on our new crop contract. And of course, everybody sold 100% of their insured production at that point, right? The reality is that's not accurate. In this particular case, I've got a technical study at the bottom of this graph that we're taking a look at that tail end of the graph to the right-hand side, which is the last 2 to 3 months where we're in this sideways pattern after the prices have dropped. And we're looking at both slow and fast stochastics. And the only reason I have that on there is so that you can see that when we're in that sideways trending pattern, if you do need to make some short-term selling decisions, you can use those tools to help you kind of pick the top end of that trading range market. So we'll refer back to this chart later on, but I just wanted you to get a quick look at a little bit of that nearby pricing history. This is my favorite chart. This is the long-term nearby spring wheat futures, and I believe this chart shows 1972, but the data set goes back to 1969. I can go back further, but it's mostly irrelevant before that. So what I wanted you to look at is that from a historical perspective, we're currently at very, very good wheat futures prices. And conversely, we're also at very good cash prices compared to history. That little spike up in the kind of the 2/3 of the way through the chart is our $25 wheat that we had back in February of 2008. And we had a considerable price drop after that. And we've actually achieved the highest prices that we've ever had, other than that spike up to $25 this last year. That $14 price would be the second highest set of spring wheat prices that we've ever had. So from a historical standpoint, we have had very high prices. From a practical standpoint, we've got some relatively tight margins, especially as we look forward with the increasing costs of virtually all of our inputs. So we need to make sure that as we go through and start talking about pricing 2023 production, that you understand that we have to take into consideration what it's going to cost us to grow that crop. Not that that shouldn't be a consideration every year, but I think we're going to be in for some surprises for a variety of reasons that we'll get into more detail on as we get further into this discussion. Growers, if growers had followed a written marketing plan, you should have made some relatively profitable sales. And I'm going to go through a couple of different examples on the benchmark plan that we put together each year that was developed last late winter, early spring. So this is, we do everything in 1,000-acre increments. And in this particular case, we've had expected yield of about 65 bushels per acre. That would cover, let's call it Central Valley, South Valley, some of the fringes as you go east and west from there. You get up into some of the areas where it's a little bit more conducive to growing wheat. We're going to have 75 to maybe 80 or a little bit more in there for potential yields. And as a matter of fact, I believe that some of our folks in the North Valley probably had one of the better wheat crops that they've had for a while, particularly on the Minnesota side. And they probably had yields that were in that 80 plus range at times. When you get further west, this numbers obviously are going to change, and we're probably going to have a 40 or even a 30 in front of that. But then your cost structure changes as well. So in this particular case, we expect to grow 65 bushels per acre. We've got a limited amount of on-farm storage, which tells us that we've got to make some sales when? At harvest time. We've got to deliver some of that wheat at harvest time if we're going to grow our APH. In this particular case, the APH is 63 bushels per acre. We choose to use a 75% revenue-based insurance policy, which means that we can insure about 47,000 plus bushels on that 1,000 acres, and we're going to put about 45,000 into a pre-harvest plan. So this is what kind of that base marketing new crop plan would have looked like. These are the price targets that we worked with, and I pulled these together for a young farmers and ranchers seminar that I was supposed to do in January out in Minot, but we got snowed out, one of the few snow days that we had this last year. So this was the benchmark plan that we put together for that group. And what you'll notice is we started, or at least we wanted to start marketing at $8.99 futures. So if we go back to our first chart, you'll notice that back in December, we were at about $8.50 a bushel when this plan would have been developed. So we were looking at somewhere around a 40 to 50 cent increase before we were comfortable starting to sell wheat. Now, keep in mind that everybody's going to have a different cost of production. And you want to make sure that your initial sales are going to be at least a break-even sale when you're done making delivery of those products. So this is a plan that assumes that you can make profit at $9 wheat futures. And you'll notice that we gave growers the option of either using futures or a hedge to arrive contract. But we've also got a minimal acceptable price of $9 in here. And we put that first sale in there at about $8.99. And then given what we look at from a plan development standpoint, we like to take a look at our annual trading range differences. And spring wheat on a calendar year basis has a tendency to trade at about a $2, $2.50, as much as $2.80 trading range. So we felt comfortable putting a little stretch in that. We'd already seen corn and soybean prices start to accelerate. So we kind of peaked out at about $12.50 as one of our highest expectations. So we went up about 50 cents a bushel on the, 7 or 8 increments that we were going to sell. And you'll notice we were selling in contract size increments, 5,000 bushel increments. If you're going to use hedge to arrive contracts, generally you can sell 1,000 to 2,500 bushel increments, which gives you a little bit more flexibility. We could have stretched out and done a few more sales if we'd have chosen to do so. Now, one of the things that we've learned from our mistakes in the past is that we try to build in some flexibility. And in this particular case, if we're in a upward trending market, which if you go back and look at that chart, we obviously were in, we give ourselves the flexibility to either use a 4 to 9 day moving average crossover as a sell signal, or in this particular case, we used a pair of trend following technicals, which were the relative strength index and the moving average convergence divergence, to help make selling decisions when we were in those upward trending markets. So we had we like to build this into both our old and new crop plans so that we can take advantage of market price rallies and capture a little bit more revenue than what we had expected to. So back to the initial slide. If we were able to achieve all of the price targets that we had in the plan, we were going to have a $10.71 futures average on our pre-harvest sales, which, by the way, that would have been a really historically good average because we've had very few opportunities where we've been able to get close to that $11 mark. So what I've done here is I've gone in and I've said, all right, I'm going to take a look at how, if we would have implemented this plan based on the delays that we put in to allow us flexibility in an upward trending market, or if we would have just sold on the calendar decision dates. So if you look at the far right-hand side, those are the decision dates, and you'll notice what the price was at closing on that price decision date. And the reason I do this is to try to help you understand that future seasonality is still alive and well. And we'll go and look at some data here in a little while that will help reinforce that. But what you'll also notice is our decision dates start in January. We like to have our first decision date generally that week or a few days prior to USDA's final crop production report from the previous year. That gives us an opportunity to stop and pause, take a look at what we've got on hand for both old crop and if we've done anything for new crop, and give us the opportunity to decide to make a sale if in fact we choose to do so, or if in fact we're above our minimum pricing objective. Then we've got another decision date in February, early February, one in mid-February, and one in early March. We cluster those around the crop insurance price setting timeframe. We set corn, soybeans, and wheat spring prices in the month of February using new crop futures. So we want to cluster at least some decisions, even if we don't make those sales, around that time frame, because there's only two ways that you can achieve and guarantee that you're going to get the crop insurance price. The number one way is to have a complete crop failure and you get a check at the end of the year. The other way to do that is to try to cluster your sales around that time frame in order to get at least some of your production sold at that price level. Now, hopefully it goes up after that, and in this particular case it did, and we're able to achieve a higher price than the average during the month of February. So we cluster those sales around that, and then we stagger them out until sometime early July. But in this particular case, we didn't have enough bushels to sell as long as we were sticking with those futures contract size hedge to arrive or futures contracts. So we left a couple of decision dates on the table, and it turned out this year that was a good thing. So you'll notice that if we'd have sold at nothing but the decision date, if we would have just put in orders and said on this day, sell at the close, you would have averaged $10.48, which is still historically a very good price, but not as good as what our price targets would have been if we would have sold exactly at our price targets. But the fact that we'd built in the flexibility to allow us to defer sales until we got a technical sell signal allowed us to achieve an average price of $11.39. So that was a significant improvement over our price targets. And the only reason we were able to get that is because we had built in our flexibility. And I'm going to go, I guess I didn't record that, but basically what we did was we waited until we got a sell signal and we made catch-up sales based on those technical sells. So our first sale was made on January 5th at $9. They traded up to $9 that day, price target and a calendar date, 2 reasons to sell. Our second, third, and fourth sales were made on March 8th. And we had deferred our price targets sales until we had a pair of technical sell signals using the RSI, which is the Relative Strength Index, and the MACD, which is the Moving Average Convergence Divergence. And we made all 3 of those sales at that time at $10.66. Then we waited again until we got another technical sell signal on May 23rd. We made 3 more sales at $12.97. Again, we could have sold at our price targets and we would have been somewhere around 60 to 70 cents less than what we achieved for an average. So the fact that we built in that flexibility allowed us to generate some additional revenue. All right, so this was as of yesterday, not at the close, but pretty darn close to the close. And I wanted to put in a couple things for you to take a look at here. The first of which, we like to watch both Minneapolis futures and Chicago futures for a variety of reasons. The primary reason is I want to know what the price relationship between those contracts is at any given moment. Not only in the front month, but also in the deferred months, because we may want to take advantages of some imbalances that occur. So as of yesterday, we had September 20, let's skip September because that's, you'll notice that there's no open interest in the September Minneapolis contract anymore, so that's an irrelevant contract. So let's skip over to the December contract. So Minneapolis was at $9.22 yesterday, near the close, and Chicago was I meant the wrong, I got to go back. It was 930 at the close, minus 864. So that was 66 cents premium, Minneapolis to Chicago. So how does that compare to normal history? Well, the average over a long period of time, if you take a snapshot of nearby futures, Minneapolis should trade about 70 cents higher than Chicago wheat futures. So we're pretty close to average. Let's go out and take a look at the new crop spring wheat contract of September 23. We're at 914, and the September contract for Chicago was 881, 33 cents. So that's about half of normal. So as a grower, if you have a brokerage account, how do you take advantage of that? How do you take advantage of an imbalance between those two futures contracts? Well, it's simple. You put on a spread trade, and what you do is you buy the undervalued contract and you sell the overvalued contract and wait till it moves to a more normal position, and then you exit that to take the profit. So if 70 cents is normal and we're only at 33 cents Minneapolis to Chicago, you buy the undervalued contract, which is Minneapolis, you sell the overvalued contract, and that's a relatively inexpensive trade to get into, and you could potentially make as much as 30 to 35 cents or even a little bit more per bushel, which then again you can add to your final sale price. And we've had the opportunity to do that 3 or 4 times on last year's crop, and now it looks like we're going to have an opportunity to do that again in next year's crop as well. So if you want to add 20, 25, 30, 35 cents per bushel to your final wheat sales, you need to consider putting those types of strategies into play. All right, so let's talk a little bit about seasonality. Seasonality still applies, even though we're in this very, very volatile time frame, and we have been for a couple of years now. The majority crop time, new crop futures are higher in January through June than they are at or near harvest time, which is why we cluster those decision dates from that time. Basis seasonality is still in play. Nearby basis ranges anywhere from about 35 under the December futures to as much as $1 under. I was out to the Big Iron Farm Show today. I talked to a pair of growers from western North Dakota, and those guys were looking at about $1 per bushel under for spring wheat for the next 2 or 3 months. As a matter of fact, I went onto a website in eastern Montana. I had an elevator out there, and they were 85 to $1 under all the way out through March. Now, that will most likely change unless we have a rail strike. Then we're going to have a different set of issues to discuss. But right now, 35 to $1 under is where most of these elevators are at. If you get into eastern North Dakota, western Minnesota, it's going to be 35 to maybe as much as 60 under, depending on where you're at. Now, historically, basis gets considerably better towards the end of the year and after the first of the year. It's not uncommon for basis to go to 0 or even over the futures. So if you've made those sales as a pre-harvest marketer and you can roll those contracts out, obviously you'd have had to roll your September contracts out prior to now, but you had the opportunity to roll out those futures or hedge to arrive contracts for 25 cents to as much as 30 cents a bushel. So if you achieved that somewhere between a 10.50 and 11.40 average, you get to add 30 cents a bushel onto that just by rolling those contracts out. So I'm going to use my 11.39, and we're going to add 30 cents onto that. So now I'm at $11.69 futures on 45 bushels per acre. That's a pretty good average for most growers. And I would expect that at some point, and as a matter of fact, I can do it right now depending on where I'm at, I can get as much as a 10 under basis for off the March futures, which would get me down to about a 1170 down to about 1150 to 1160 cash. That's the opportunity you have for your sales that were made pre-harvest. We almost always see basis improvement from harvest to spring, and it generally starts to occur in December and sometimes a little bit later than that. Okay, so now that we've talked about what could have happened or what a lot of growers had occur, What about the crop that, well, let's talk about this first. We got to finish pre-harvest pricing on anything that we haven't delivered yet. So we can either deliver it now, take current basis, and any protein discounts, if any, that are in play now. If you're going to do that without rolling it ahead because you don't have storage, or you're concerned about basis collapsing, or you're concerned about protein discounts getting wider, you can deliver that grain and you can buy bad futures. And we looked at this a little bit earlier, but you have to decide which month you're going to buy back. And in my mind, I would buy July 23 futures if I'm going to re-own some or all of the product that I've already sold, whether that was pre-harvest marketed or if I'm marketing it now. So if that's the case, I'm going to go clear out to July because it's only trading at a slight premium to March, and it's actually trading at an inverse to May. So I don't have to buy any carry if I'm buying those futures back. Then it'll give me an opportunity to take advantage of any market price rally that may occur. And we're going to take a look at some pricing history so that you have a little bit more confidence to do this if in fact you're in a position to do so. What would be another reason to make cash or cash forward sales now? Has anybody's interest rate gone up on their operating loans? The answer to that is yes. As a matter of fact, we had a reset back on August something, and a lot of those rates went up 2%. So now all of a sudden I'm paying more interest than I have been. So there may be good reason to make cash sales and buy these futures back and use a lesser amount of capital and pay down your operating line so you're not paying as much interest. So that'll become a bigger and bigger factor now that rates are on an increase. So roll those HTAs out, fix the basis. Initially, I would have suggested that let's just hang out and wait on basis. But we've got a relatively serious potential problem arising with a potential rail strike. If the railroads go on strike, what happens to basis? Basis is going to widen out incredibly. So you may want to, as you roll those contracts ahead, even if you're not offered the very best basis that you might expect to be offered at some point in the future, from a defensive position, you may want to consider rolling those into a cash forward sale. And then a lot of times you can take an advance on that through the elevator, take that cash and either buy back futures or pay down your operating and buy back some of those futures. So it becomes a relatively complicated system because of what's going on from a labor standpoint and from a cost of capital standpoint. It's not as simple as it has been when everybody had interest rates on their short-term money in the 4s, or perhaps even a little bit less at times. So it becomes a little bit more complex, a little bit more complicated, and there's a lot of other factors that need to be taken into consideration that aren't necessarily related to production, but are an outside influenced factor. Okay, so what do we expect futures to do from now until we move into winter and spring? Current protein discounts are minimal at this point. Do we expect them to get better? Do we expect them to get worse, or don't we know? How about current basis? Well, I've already had that discussion. Current basis is not overly attractive. There's a lot of elevators or end users that are offering considerably better basis once we get past the end of the or first of the year that we may want to take advantage of in case that we have an extended rail situation. So normally we would expect them to improve, but there's that level of uncertainty that we need to address. So what we did was we went back and we took a look at futures price change throughout the year going back to 1996. Why did we pick 96? Well, 96 was the year that the Farm Bill changed dramatically to what they called freedom to farm. And we had a rapidly changing mix of crops, particularly in the northern plains. When I first moved to west central Minnesota in 1994, we had 80,000 acres of small grains in the county that I live in. We're down to less than 10,000 acres of small grains in that same county now, primarily because of the growth of corn production as corn production has moved further north. So this is what we found. We found that since 1996 through what's been used up of 2022, 11 out of those 27 years, the high futures price in the nearby contract occurred in the second quarter. The last half of the year, 2/3 of the time, split evenly between the third quarter and the fourth quarter, we generally saw our low prices. Okay? Now we'll look at a slide a little bit later that has the last 6 or 7 years on it, and you'll see what happened this year and the years that just changed. So excluding 2008, I threw that one out because that skews the average too much. If you take a look at the 24 years out of the last 27 where the price was higher than the September low by the end of June. Why the end of June? Well, because if I'm going to buy July futures, I got to be out of them by the end of June, don't I? So this is a time frame snapshot of whenever the low occurred in September, which the way it looks right now, we've probably seen our low, and I'll show you what that was here in a little bit. And then this carries out all the way through the end of June. And what we found is that those 24 years out of 27 where the price at some point in time after the first of the year before the end of June, we went up an average of $1.32. Now, there was a year where it only went, actually we had 1 year where it was zero. We actually had the same high as we had the low in September. So that one is in the next set of data. And we had 2 years where the price was actually lower from January to the end of June than we had on our September low. So it doesn't happen very often, but it can occur. So that $1.32 needs to be in the back of your mind. The range was anywhere from 28 cents to I think as much as $3.50. If you're interested in that data, I can send you the spreadsheet that's got it in there. But what I wanted you to know is that we've got a very high percentage probability of having better pricing opportunities for our old crop wheat, particularly in the second quarter of next year, than where we're at right now, or where we've been in our September low. All right, so here's what we need to take into consideration as you develop a post-harvest marketing plan. And boy, it's important that you have a plan in place, because otherwise, if you don't have a map to where you're going, any road will do, won't it? You can go down any road you want to, and you may or may not make profitable decisions at that point in time. So the first thing you do is determine how much production you have left to market. Evaluate your cash flow needs. We've kind of touched on that a little bit. You got to have money at certain times of the year, and then your delivery time frame. We've got growers that they want to have as much of their old crop delivered by road posting time, the end of March, as possible. A lot of growers that don't have cash flow demands, they can go all the way out to June, July, or even August before they have to make those decisions, although with interest rate changes, that may become a little bit different decision-making process. So we got to put in some decision dates, and quite frankly, we use the same dates every year, clustered around what we've briefly described, and we use the same dates for old and new crop. And it's pretty easy to just readjust those based on the day of the week that they fall in, and use those same dates to pause and take a look at your marketing plan. And then you've got to set your price targets based on whatever the current futures price is and whatever expected price change and potential that you have up to your desired delivery time frame. So if you have limited or no storage, you can still sell now or within the next week or 10 days or whatever it is, and then use this plan to potentially improve your revenue by buying back those July futures. And then using the same tools that we're going to cover in terms of making those selling decisions. If you buy back futures, I would put together an exit strategy that's built just like an old crop marketing plan, where you exit those positions based on price targets, based on calendar dates, but also include the flexibility that allows us to take advantage of an upward trending market. Okay, so with all that said, so far this month, our September futures low has been $8.68. That was the nearby futures. Okay, now we're in December because September no longer exists. So with an average post-harvest futures price, not accounting for futures price carry, I'm just talking about nearby futures, we could very easily see $10 futures in the nearby in the next few months. As a matter of fact, we're only 70 cents away from that. We're at $9.30 yesterday, and I think we're up about 7 or 8 cents today. So we're not that far away from having $10 futures, and you can decide if you want to set basis before you set futures price, if in fact you're concerned about an extended basis challenge with this potential rail upset that we've got going on. I have higher expectations on nearby futures than that, just because of the general volatility in futures prices and what we saw happen this last week in both corn and soybeans when we had a USDA report that came in outside of the trade's expectations, where soybeans went up 60 cents and we had a nice jump in corn as well. Now, the other thing that you have to take into consideration, I'm going to go clear back to that slide that we had earlier, and we like to calculate what our levels of price resistance are, and that's a relatively easy thing to do. You take the high, which in this case was $14, and you take the low that occurred back in August, which was $8.50 some, and you do this kind of math. So we had 515 low, or 515 price drop from the 1390 futures, and we get to add that onto the 875 low that we had in August. So if you just take in that 515, divide it by 3, that's $1.72. You add it on to the 875. Our next level of futures price resistance on the nearby futures is $10.47. So with a $1.32 increase from the September low and the 1047 resistance level, I would put my first or my next price target in somewhere between $10 and $10.47. Split it. What the heck? Go in at about $10.24 in using March futures. Don't have enough time in D, so I want to use March. Okay? So that would probably be where I would start an old crop marketing plan, but I would also build in that flexibility to allow me to take advantage of a price rally, if in fact that occurs. Okay? So 50% retracement gets us up to 1133. 2/3 retracement gets us up to 1219. 75%, 1261. 87.5, 1326, or the full retracement at 1390. Now, these are not price targets. All these are levels of technical levels of price resistance. So if we trade through the 1047, then I don't have another level of price resistance until I get to 1133. So I'll set in price targets somewhere above that. So as I develop my old crop plan, I'm going to have dates in place, but I may not have a lot of price targets because I want to find out if in fact I can trade through that 1047 and if in fact I can trade through that 1133 before I start putting those price targets on paper. But I'm going to have these sitting right by there so I know where I need to be at. Then I can make those decisions as we get closer. Not being the grower that does the lift as approach strategy unless you're going to use a technical indicator to help you make and reinforce that selling decision. Okay? So it's important that you understand that the trade and that these levels of price resistance are real and that we can use them as a guide to help us set price targets as we move forward. So if I am going to go ahead and put those price targets in, I'm probably going to start somewhere in that 1024-ish range, and I'm going to go up at least 35 cents to maybe as much as 50 cents above that as I set price targets. But I want to make sure I build in that flexibility. I want to build in the ability to defer if I'm in an upward trending market. Now, one of the things I always ask growers when I am helping them develop an old crop plan, and I don't care if it's wheat, if it's corn, if it's soybeans, or if it's pickles, how much production do you want to put into the Vegas bushel category? What does that mean? That means I'm going to wait to see if I can't get the big jackpot, what, $18 soybeans, $8 corn, $14, $15, $16 wheat, and if I don't get it by a certain date, we will sell it at that price, whatever it is, and never speak of it again. So you got to decide where you're at in terms of how many bushels am I willing to gamble with. And then the rest of the bushels get put into the old crop marketing plan. Then you have to decide which technical tool or tools that you plan to use to help make these pricing decisions in the event that we do go on that price rally, as we occasionally do and as we have done the last couple of years. So once that plan is in place, it's developed and written down, share it. Okay? Pick somebody to share it with, whether it's your spouse, business partner, a lender, key employee, somebody else. That way you've got some accountability in implementing the plan. There's nothing like your wife looking over your shoulder saying, didn't you say you were going to make a sale A on this date, A at this price target, or B or C when we hit this technical price indicator? Okay? It's important that you have some accountability on this because it's really easy to put it aside. Also, put those decision dates on your calendar on your phone so that you have an alarm goes off at noon that day that says, today is a decision date. And it will cause you to look at futures. It'll cause you to dig out the plan. And if your spouse or significant other or business partner also has that on their phone, they can send you a text that says, say, weren't you supposed to look at the markets today to see if you were supposed to be making a sale or not? All right, so that's where we're at. So now comes the fun stuff. What are we going to do for next year? Well, the first thing you have to do before you do anything else is sit down and do a detailed budget. Now, we're at a time of year where you may not have time to do that right now. So you can swag it a little bit in case we go on a significant price rally, but it's critically important that you do a detailed budget so that you know what it's going to cost you to grow next year. Now, we started doing budgets clear back in July for 2023. And we started doing that for a few reasons. Number one, we had some growers where land that they had been farming was going to come up for sale. And they were not necessarily going to be in a position to buy part or all of that land. So we had to take into consideration what their change in land volume was going to do to their operation. We also had some farmers retire, and we had some growers that were going to pick up some additional land next year. So we had to start doing budgets so that we knew what the implications and what we could afford to pay for added acres for the following year. So we started doing these budgets and we started to gather up fertilizer prices. And what we found was that, and I don't care if I was in central Iowa, southern Minnesota, west central Minnesota, or eastern North Dakota, we were looking at 80 cents to $1 per bushel increase in our cost of production of corn. Anywhere from $150 to $200 per acre higher in 1 year. Okay, now, if I have to approach my lender and say, okay, last year my 200 bushels of corn cost me $880 an acre to grow. With the fertilizer price increase, with the increase in interest rates, with the increase in any other costs that we will incur, and we could spend several hours on this, which we don't have, I'm going to need an extra $200 an acre. I'm going to go from $880 up to almost $1,100 an acre. Now, part of that's going to be my own capital. In a perfect world, about a third, right? 33%, 35%. Should be my own capital that I put at risk. I can afford to borrow the rest. So in other words, I should have 35% working capital in my operation. If I'm farming 5,000 acres and it costs me an average of $1,000 an acre, that's $5 million times 35%. That's how much money of my own I should put at risk. All right, that's enough of the throwing numbers out. So we just need to make sure that you have a good idea what your cost of production is, and then use that as your base price. Now, if your base price, your break even is too high, you better spend the winter figuring out what you can do within your operation to fix it. Or switch to a different crop that you're going to be more competitive growing, And then once you've got that done, you need to review your annual nearby futures trading range prices so that you can put together a well thought out new crop marketing plan. So I told you we were going to take a look at the price changes annually going back to 2015. And what you'll notice here is that even though we had a $5.63 trading range from high to low this calendar year, it's not the highest percentage that we've had in the last 7. We actually had a higher percentage change in 21 with an 83% percentage change. And we weren't that far off in 2017 when we had almost a 62% change. Okay? So if you look at the summary at the bottom, the median calendar year range is $1.40. The average is $2.45. The highest was $5.63. That was this year. But these are things that you need to use to put into your new crop marketing plan. You saw this in a different format earlier. Generally in spring wheat, almost 41% of the time our nearby futures high occurs in the second quarter. So that would be April, May, or June. 66% of the time, half of the time, it occurs August through, actually July through December. So 2/3 of the time. So you need to make sure that you cluster those sales early on. We don't have a lot of time here. I've given the 5-minute warning just a couple of minutes ago. USDA just recently dropped production of both corn and soybeans, decreasing both acres and production. I would expect corn yields to be lower for a variety of reasons. Regionally, we're going to have some test weight challenges. We lost a fair amount of kernel depth recently, and that's going to impact our test weights, and that has an impact on yield. Basis for both corn and soybeans has been relatively good. If you have an opportunity to lock basis, I would do that at least on some of your production because of the potential threat of basis increase with that railroad strike or the potential of a railroad strike. Yield uncertainty may be an issue for some growers. We're certainly seeing lower corn silage yields in my part of the world. Generally, we're in that 20 to 25 ton range. This year, we're seeing yields as low as 10 ton per acre and very few yields over that 20 ton per acre range. So we'll believe we have some nice opportunities currently for both old crop and new crop pricing in corn and soybeans. Stay tuned to see how things play out. With that, do we have questions that have come in? Nothing. How about questions in the room? I must have done a masterful job of covering everything that anybody wanted to hear. Or they're just hanging out waiting for the speakers that actually know what they're talking about. All right, with that, I'll pass it off and we'll move ahead.